I want you to imagine something with me. I want you to imagine staying awake for 72 hours straight. I want you to imagine being glued to your screen in the middle of the night, watching numbers move so fast that your brain cannot process what is happening. I want you to imagine watching a year's worth of gains evaporate in less than 20 hours. Now I want you to understand that this is not a hypothetical. This is what happened to traders all over the world last week. This is what happened when China decided it was time to take profits. And if you do not understand what just occurred, if you do not understand who is really driving this market and why they suddenly reversed course, you're going to be blindsided again and again until you have nothing left. Ladies and gentlemen, Mr. AG here, your Asian guy, and we need to have a serious conversation about what just happened in the precious metals market. Because the mainstream narrative, the story they are feeding you about Kevin Warsh and margin requirements and technical corrections, that is only the surface layer. That is the explanation for children. The real story, the story that explains why January 2026 will go down as the most volatile month in precious metals history, that story starts in China. It ends in China. And if you want to survive what is coming next, you need to understand exactly how Beijing just played the entire Western financial system. Let me set the stage. For weeks, maybe months, traders across the metals world have been living in a state of constant exhaustion. They have been working around the clock, unwilling to miss the Asian trading session because that is when the real action was happening. European traders were setting alarms for 2 a.m., 3 a.m., because they knew that when China woke up, the market was going to move. And it always moved in one direction, up, relentlessly up. Gold went vertical, silver went parabolic, copper spiked past $1,400 a ton. Tin at levels nobody thought possible. And all of it, every single bit of it, was being driven by one thing: Chinese hot money. I need you to understand who was buying. This was not central banks accumulating reserves. This was not industrial demand for silver and copper. This was speculation, pure and undiluted. Individual investors in China, retail traders looking to get rich quick, large equity funds that had never touched commodities before, suddenly deciding that metals were the place to be. They piled in with leverage. They piled in with options. They piled in with a fervor that veterans of the market had never seen before. And as they bought, the price went up. And as the price went up, more people bought. It was a feedback loop, a mania, a bubble inflating in real time. The head of trading at Hiraeus Precious Metals, one of the largest bullion refiners on the planet, said something that should chill you to the bone. He said, "In my career, it is definitely the wildest that I have seen." And then he said something even more telling. He said, "Gold, it is a symbol of stability. But such a move is not a symbol of stability." Let that sink in. The asset that is supposed to represent safety, the asset that people buy to protect themselves from chaos, that asset was moving in a way that was fundamentally unstable. It was moving because of speculation, not fundamentals. It was moving because the Chinese gamblers had decided that metals were the new casino. And it was not just the professionals who noticed. The signs were everywhere. At the world's biggest coin conference in Germany last week, executives were supposed to be networking, making deals, talking about the future of the industry. Instead, they were standing around staring at their phones in silence, watching the crisis unfold in real time. They knew something was wrong. They knew the market had decoupled from reality. They knew a reckoning was coming. They just did not know when. The when turned out to be Thursday night and Friday. And the trigger was Kevin Warsh. When Bloomberg and other news organizations reported that President Trump was planning to nominate Kevin Warsh as the next Federal Reserve Chairman, the dollar immediately strengthened. And when the dollar strengthens, gold weakens. That is the simple mechanical relationship. But what happened next was not simple. What happened next was the most dramatic crash the precious metals market has ever seen. Silver dropped 26% on Friday. 26% in a single day. That is the biggest single-day drop in the recorded history of the silver market. Gold dropped 9%, its worst day in more than a decade. And here is the thing that nobody in the Western media wants to talk about. The selling started in Asia. The selling started in China. The same Chinese speculators who had driven prices to the moon decided, all at once, that it was time to take profits. And when they sold, they did not sell gradually. They did not ease out of their positions like responsible investors. They hit the sell button with both hands, and they did not stop until the market was in free fall. One analyst put it perfectly. He said, "China sold, and now we are suffering the consequences." That is the entire story in 7 words. China sold, and now we are suffering the consequences. The West did not cause this crash. The West did not start this rally. We were passengers on a train that China was driving, and when China decided to jump off, we went over the cliff. Now I need to tell you about something that happened this week that most Western investors have completely missed. Because while you were watching the price collapse, while you were checking your portfolio and feeling sick, 6 major Chinese banks issued emergency warnings to their customers. 6 banks? Not 1, not 2, 6. And they all issued these warnings at the same time, in the same week, with the same message. The Industrial and Commercial Bank of China, the largest bank in the world by assets, issued a notice telling investors to maintain a rational investment mindset and avoid blindly chasing rallies or selling into dips. They urged customers to make a prudent assessment of personal risk tolerance. The Bank of China told its clients engaged in precious metals businesses to take precautions against growing market risks. The Agricultural Bank of China, China Construction Bank, Postal Savings Bank of China, and the Bank of Communications all announced adjustments to gold-related businesses and reminded investors of ongoing trading risks. Let me ask you a question. Do you think it is a coincidence that 6 of the largest banks in China all issued the same warning at the same time? Do you think they all independently decided that this week was a good time to remind their customers about risk management? Or do you think maybe, just maybe, they received instructions from somewhere higher up? Do you think maybe Beijing saw the frenzy, saw the leverage building in the system, saw the potential for a catastrophic unwinding, and decided it was time to cool things down? I'm not a conspiracy theorist, I'm a pattern recognition machine. And the pattern here is unmistakable. China pumped the market. China crashed the market, and now Chinese banks are telling their citizens to be careful. This is not random. This is coordinated. This is a government that is trying to manage a situation that got out of control. But here is where it gets really interesting. Here's where the Western narrative completely falls apart. Because while the paper price of silver was crashing on 26%, while gold was having its worst day in a decade, the physical market in China was telling a completely different story. In Shuibei, the largest bullion trading hub in China, traders reported that there was no panic selling. I need you to hear that. No panic selling. The paper market was in freefall. The futures were limit down. The ETFs were getting obliterated. And in the actual physical market, where real metal changes hands, there was no panic. There was more selling than buying over the weekend, yes, but it was orderly. It was calm. And here's the kicker. Shuibei silver prices were still trading at a premium to exchange contracts. A premium. That means physical silver in China was more expensive than the paper price on the exchanges. What does that tell you? It tells you that the Chinese who actually understand this market, the ones who deal in physical metal rather than paper derivatives, they were not scared. They were not panicking. They were waiting. They were letting the weak hands get shaken out, letting the leveraged speculators get liquidated. They were positioning themselves to buy the dip. One trader in Shuibei said, "Gold is relatively strong. I see a lot of dip buyers coming in the past 2 days to purchase jewelry and bars before Lunar New Year." The Lunar New Year, the biggest gift-giving season in China, the time when families traditionally buy gold for good luck and prosperity. And instead of running away from precious metals, Chinese retail buyers are lining up to take advantage of lower prices. Meanwhile, at Heraeus in Germany, they are sold out of certain bar sizes, weeks in advance, and people are still buying. The head of trading said, "People are queuing for hours in front of these shops in order to buy products. Hours in line to buy physical metal." Does that sound like a market that is topped? Does that sound like a bubble that has popped? Or does that sound like a market where the smart money is accumulating while the paper traders are panicking? Now let me tell you about what happened in the options market, because this is crucial to understanding how the crash unfolded. In the weeks leading up to the top, activity in options on precious metals ETFs went absolutely insane. The iShares Silver Trust, ticker symbol SLV, recorded more than $40 billion in turnover on Friday alone. $40 billion in one day. On a silver ETF that normally trades maybe $2 billion, that made SLV one of the most traded securities on the entire planet. And it was not just volume, it was the nature of the bets. Retail traders, many of them from the Reddit communities that had powered previous meme stock rallies, were piling into call options on silver. Posts were showing gains of over 1,000% from betting on silver's rapid climb. When you have that many call options outstanding, it creates conditions for a squeeze. As the price goes up, the dealers who sold those options have to hedge by buying the underlying asset. That buying pushes the price up further, which forces more hedging, which pushes the price up more. It is a rocket ship powered by gamma. But here's the problem with rockets. They can go down just as fast as they go up. When the price reversed, when China started selling, all those call options started losing value. The dealers who had been buying to hedge suddenly needed to sell. The selling pushed prices down, which made the options worth even less, which forced more selling. The same gamma that powered the rally to absurd heights powered the crash to terrifying depths. One former head of commodities at Bridgewater Associates explained it perfectly. He said, "As we squeeze up, They have to mechanically keep buying more, and that would explain why we go up so fast and down so fast. The speed was not about fundamentals. The speed was about market structure. The speed was about leverage and options and mechanical forces that amplify every move in both directions. And now the Shanghai Gold Exchange has gotten involved. On Monday, they issued a notice adjusting the margin rate and price limit for silver-deferred contracts. They told all members to ramp up risk awareness, make detailed risk contingency plans, advise investors to strengthen risk prevention, reasonably control positions, and invest rationally. That is bureaucratic language, but the message is clear. The authorities are trying to prevent this from happening again. They are raising the cost of speculation. They are trying to squeeze the leverage out of the system. But I want you to think about what this really means. The Shanghai Gold Exchange, which is controlled by the Chinese government, is taking steps to reduce speculation in precious metals. At the same time, 6 major Chinese banks are warning their customers to be careful. At the same time, the physical market in China is calm and buyers are waiting for lower prices. What does this pattern suggest to you? It suggests to me that China is playing the long game. They allowed the speculation to run hot. They allowed their citizens to drive prices to record highs. Maybe they even encouraged it as a way to destabilize Western markets and drain physical metal from Western vaults. But when it got too hot, when the bubble became dangerous, they let the air out. They took profits at the top. They crashed the market. And now they are positioning themselves to accumulate again at lower prices. This is not incompetence. This is strategy. This is a country that thinks in decades while the West thinks in quarters. This is a country that has been accumulating gold reserves for years, that has been building a parallel financial system, that has been preparing for a world where the dollar is not the only game in town. And they just showed us exactly how powerful they have become in the precious metals market. The question you need to ask yourself is simple. What side of this trade do you want to be on? Do you want to be on the side of the leveraged speculators who got wiped out? Do you want to be on the side of the paper traders who are now sitting on massive losses? Or do you want to be on the side of the patient accumulators, the ones who buy physical metal, who do not use leverage, who understand that volatility is the price of admission to a market that is ultimately going higher? Let me give you some perspective on the fundamentals, because amidst all this chaos, the fundamentals have not changed. The factors that drove gold from $1,800 to $5,500 are still in place. The U.S. government is still drowning in debt. The Federal Reserve is still trapped between inflation and recession. Geopolitical tensions are still elevated. Central banks around the world are still buying gold at record pace. None of that changed because of Kevin Warsh. None of that changed because Chinese speculators took profits. One analyst quoted in the Chinese press said it perfectly. He said, "The factors supporting the growth of gold remain unchanged." He mentioned rising geopolitical tensions, global central banks' increased gold holdings, and excess liquidity across international financial markets. Those are the fundamentals. Those are the reasons why gold went up in the first place, and those reasons are still valid. Another analyst said that after the technical correction, the prices of gold and silver are expected to rebound this year, though the growth rate is unlikely to be as rapid as we saw in early January. That is probably right. The easy money has been made. The parabolic phase is over. But that does not mean the bull market is over. It means we are entering a new phase, a consolidation phase, where the weak hands get shaken out and the strong hands accumulate. Heraeus Precious Metals, one of the most respected firms in the industry, projected back in December that precious metals would reposition and consolidate in 2026, following the prolonged period of price surges. They forecast an average gold price range of between $3,150 and $5,000 per ounce this year. Even at the low end of that range, gold is still dramatically higher than it was 2 years ago. The trend is intact. The bull market is intact. What we just experienced was not the end. It was a violent reset within a larger uptrend. But I need to warn you about something. I need to warn you about the way this crash is being used to shake your confidence. Because right now there are forces that want you to sell. There are forces that want you to believe that precious metals are over, that the bull market has topped, that you should take whatever you have left and put it into something safe like treasury bonds or cash. Do not listen to them. They are trying to buy your metal at depressed prices. Think about who benefits from a crash like this. The bullion banks, who are short precious metals, they benefit. They were getting squeezed as prices went higher and higher. Every dollar that gold went up was money out of their pockets. But when the price crashes 10%, suddenly their short positions are back in the money. Suddenly they are not facing margin calls. Suddenly they can breathe again. They needed this crash. And I would not be surprised if some of them helped engineer it. Think about the central banks. They have been buying gold relentlessly for years. They want to accumulate as much as possible before the next phase of the monetary reset. Do they want to buy gold at $5,500? Or would they rather buy it at $4,700? Obviously, they want lower prices. A crash like this is a gift to central bank gold accumulators. It lets them buy more ounces with the same amount of money. Think about China specifically. The Chinese government has been encouraging its citizens to buy gold for years. They want as much gold inside China's borders as possible. They want their population to be protected when the dollar system eventually fails. A crash that shakes out Western speculators but leaves Chinese physical buyers calm and ready to accumulate? That is exactly what China would want. That is exactly what serves their long-term interests. I'm not saying this was all a master plan. Markets are complex. There are millions of participants making independent decisions. But I'm saying that the outcome of this crash serves certain interests very well. And those interests are not your interests. Your interests are served by holding onto your metal, by not panicking, by understanding that volatility is the price of admission to a market that is being contested by the largest economic powers on Earth. Let me tell you what I think happens next. In the short term, we are going to see more volatility. The margin requirements have been raised on both the CME and the Shanghai Gold Exchange. That means leveraged positions will continue to be unwound. There may be more forced selling in the days ahead. The price could go lower before it goes higher. Anyone who tells you they know exactly where the bottom is, they are lying to you. Nobody knows. But in the medium term, I expect we are going to see a recovery. The Lunar New Year is coming. That is traditionally a period of strong physical demand in Asia. The dip buyers in Shuibei are already lining up. The premiums on physical metal remain elevated. The fundamentals have not changed. Once the leverage is flushed out of the system, once the weak hands are gone, the market will find its footing and start climbing again. And in the long term, I remain completely convinced that precious metals are going much, much higher. The debt levels are unsustainable. The monetary system is broken. The geopolitical order is fragmenting. Gold and silver are the only assets that have no counterparty risk, that cannot be printed by a central bank, that have served as money for 5,000 years. Nothing that happened last week changes any of that. So here is what I want you to do. First, if you are holding physical metal, do nothing. Absolutely nothing. You did not lose anything because you did not sell anything. The paper price fluctuated. So what? Your ounces are still there. Your wealth is still preserved. The whole point of owning physical metal is to have something that cannot be wiped out by a margin call or a computer glitch or a coordinated attack by speculators in Asia. Mission accomplished. Second, if you're holding paper positions and you got hurt, take some time to reassess. Ask yourself why you were in those positions. Were you speculating or investing? Were you using leverage you could not afford to lose? Were you chasing a parabolic rally at the top? If so, this is an expensive lesson. But it is a lesson that can make you a better investor going forward. Learn from it. Adjust your approach. And next time, focus on physical metal that you own outright, with no leverage, no counterparty risk, and no margin calls. Third, if you have dry powder, if you have cash on the sidelines, start thinking about when to deploy it. I'm not saying to buy today. I'm not saying the bottom is in. But I am saying that the prices we are seeing right now are dramatically lower than they were a week ago. If you believed in precious metals at $5,500 gold and $120 silver, you should believe in them even more at $4,700 gold and $80 silver. The fundamentals are the same. The price is lower. That is called a buying opportunity. Fourth, pay attention to what China is doing, not what China is saying. The banks are issuing warnings about volatility. But the physical buyers in Shuibei are lining up. The government is raising margin requirements. But the central bank is still accumulating gold. Watch the actions, not the words. China is positioning itself to own as much precious metal as possible. When this is all over, you should be doing the same. Let me leave you with this thought. January 2026 will go down in history as the most volatile month in precious metals ever recorded. The moves we saw, both up and down, were unlike anything that has happened in our lifetimes. 40 years. That is how long it had been since gold had a day this bad. And silver had never, ever had a day this bad. Ever. But here's the thing about historic moments. They cut both ways. Yes, people got hurt. Yes, portfolios got destroyed. Yes, the weak hands got shaken out. But the strong hands, the patient accumulators, the ones who understand what precious metals really represent, they just got handed an opportunity. They just got given lower prices to accumulate. They just got confirmation that the market is alive, that it is contested, that powerful forces are fighting over the future of money itself. The crash was not the end of the story. The crash was a chapter. And if you have the wisdom to understand what is happening, if you have the patience to ride out the volatility, if you have the courage to buy when others are selling, this chapter could be the one where your fortune is made. China just showed the world how powerful they have become in the precious metals market. They pumped it. They dumped it. They issued coordinated warnings through their banks. They adjusted margin requirements through their exchanges. They demonstrated that they can move these markets whenever they want, in whatever direction they want. That should terrify you if you are playing their game by their rules with leverage and paper derivatives. But it should encourage you if you are playing a different game, the game of physical accumulation, the game of patient wealth preservation, the game of owning real assets that cannot be manipulated away by an algorithm or a margin hike or a coordinated dump by Chinese speculators. The volatility is not going away. If anything, it is going to intensify as the battle over the future of the monetary system heats up. There will be more crashes. There will be more rallies. There will be more days when you question everything and wonder if you made a terrible mistake. That is the nature of this market. That is the price of admission. But at the end of this road, when the dust finally settles, when the paper games are over and only physical metal matters, the people who held on, the people who accumulated, the people who refused to be shaken out, they are going to be the winners. And the people who panicked, the people who sold at the bottom, the people who let China scare them out of their positions, they are going to regret it for the rest of their lives. I know which side I am on. I know what I am doing with my wealth. I am not playing China's game. I am playing my own game. And in my game, physical metal is the only thing that matters. This is Mr. AG, your Asian guy. China showed their hand. The crash was not an accident. And the bull market is not over. Stay physical, stay patient, stay ready.